Friends, welcome to this rapid audio revision series on accounting standards of Group 2 Advanced Accounts. I am CA Jayesh Popat from Jayesh Popat's Classes, Kolkata. Please download the revision notes from the link given in the description. Also, subscribe to our YouTube channel and hit the bell button. I hope these revision notes will help you to easily, effectively revise your accounting standards in the shortest possible span of time. All the best for your exams. Thank you. ACE 14 Accounting for Amalgamation. Amalgamation in simple sense would mean joining or combining something. In a corporate reporting scenario, we could envisage two scenarios in relation to amalgamation. One is where there are two or more companies which agree to pool in their resources and operate as a single entity. For example, let's say there are two companies, X Limited and Y Limited. Now they agree to transfer their assets and liabilities to another company which is XY Limited. Right? This new company has been incorporated to take over the assets of X Limited and Y Limited, and now these two entities will operate as a single entity. This would lead to an amalgamation where there are two or more existing companies. One new company is formed which takes over the assets and liabilities of the existing companies, and the existing companies would be dissolved. The company which will transfer its assets and liabilities to the other company will be known as the transferor company or the vendor company, and the newly incorporated company now which will operate as a single entity will be known as the transferee company or the purchasing company. Another scenario which we could envisage is, let's say there are two companies, right, two existing companies, wherein one company will take over the business, that is the assets and liabilities of the other company, and then the other company would be dissolved. Let's take an example. Let's say there are two companies, A Limited and B Limited. Now A Limited takes over the business of B Limited. So A Limited is the transferee company or the purchasing company, and B Limited is the transferor company or the vendor company. In this case, there are two companies. No new company is formed. One company takes over the business of the other company, and the other company may lose its existence. Now we'll talk about the types of amalgamation. See how the amalgamation is structured, right? Will, let's say, result into what type of amalgamation it is, right? There are two broad categories of amalgamation: amalgamation in the nature of merger and amalgamation in the nature of purchase. Amalgamation in nature of purchase is pretty simple. It says that if it is not an amalgamation in the nature of merger, it automatically qualifies as amalgamation in nature of purchase. So we need to understand what is amalgamation in the nature of merger. It says that there are 5 conditions, and all these 5 conditions needs to be satisfied if it has to qualify as amalgamation in the nature of merger. This is important because it could come as a theoretical question, 5-mark theoretical question, and also while we are attempting our practical question, we need to determine that what is the nature of amalgamation, whether it is in the nature of purchase or it is in the nature of merger. So we need to keep these points in mind. Let's start off. So the first point is that all the assets and liabilities of the transferor company are to be taken over by the transferee company. Second point, shareholders holding not less than 90% of the face value of the transferor company should become the equity shareholders of the transferee company. That means that virtually, substantially all the shareholders of the transferor company are now becoming the shareholders of the transferee company. Then the purchase consideration for the equity shareholders of the transferor company should be paid in form of equity shares of the transferee company. If there is any fraction of share, then cash can be paid for fraction of share. So all the shareholders of the transferor company are getting only the equity shares of the transferee company. Then the fourth point is that the business of the transferor company is intended to be continued by the transferee company. So it's not a scenario where a takeover is done and the business is shut down. The transferee should intend to continue the business of the transferor company. Another important point, what will happen? See, once A Limited will acquire the business of B Limited, that will acquire the assets and liabilities of the B Limited. It will have to incorporate these assets and liabilities in its balance sheet. So this point says that no adjustment is intended to be made to the book value of the assets and liabilities of the transferor company, right, except when it is required to adjust for the uniformity of accounting standard. This means that the assets and liabilities of transferor company would appear in the balance sheet of the transferee company at the same value at which they were appearing in the balance sheet of the transferor company. So there is no revaluation allowed of assets and liabilities in case if it is an amalgamation in the nature of merger. So these 5 points needs to be satisfied if it has to be qualified as amalgamation in the nature of merger. If one or more points do not qualify, it will automatically qualify as an amalgamation in the nature of purchase. Then we'll understand what is purchase consideration. See, in most simple sense, when we buy something, we need to pay a price to buy that particular thing. This price that we pay is called purchase consideration. So in this case, what is happening, that one company is purchasing the assets and liabilities of the other company. So that company which is purchasing the assets and liabilities will have to pay the price to get those assets and liabilities. This price which is being paid is known as purchase consideration. Another very important thing which you should keep in mind is that when I am buying something, I have to buy that from the owner of that particular thing. So when one company is buying the assets and liabilities of another company, the purchasing company will have to buy these assets and liabilities from the owners. And we know that in case of the company, owner are the equity shareholders, right? So in this case, whenever we talk about purchase consideration, right, it is the value paid to the equity shares and preference shareholders only, right? If the transferee company is, let's say, paying off the debenture holders of the transferor company, that does not form part of the purchase consideration. So what is purchase consideration? It is the amount payable by the transferee or the purchasing company to the equity and the preference shareholders of the transferor company. Now this purchase consideration can be in form of cash, can be in form of equity share of the transferee company, can be in form of preference shares of the transferee company, can be in form of debentures issued, etc., right? So, but you need to keep in mind that purchase consideration should comprise of only the amount which is to be paid to the equity and the preference shareholders. Then we'll talk about the method of accounting, right? There are two methods of accounting which are prescribed under Accounting Standard 14, pooling of interest method and purchase method, right? Under pooling of interest method, the assets, liabilities and reserves of the vendor company are to be recorded in the books of the purchasing company at its book value. That means no revaluation can be done. This means that this method will be applicable in case of amalgamation in the nature of merger, because we saw 5 conditions in which the 5th condition was that no adjustment is intended to be made to the book value of the assets and liabilities. So pooling of interest method will be applicable in case of amalgamation in the nature of merger. And we should remember that under this method, the assets, the liabilities and the reserves, right, these are taken up, right, and they have to be recorded at the book value. When we talk about the purchase method, it says that assets and liabilities are to be recorded either at book value or at fair value. So it depends upon how the transaction has been structured. If the assets are taken at book value, it will be recorded at book value. If certain assets have been revalued, right, then the assets will be recorded at revalued amount. So obviously this is applicable for amalgamation in the nature of purchase, because if in case of amalgamation in the nature of merger, you cannot make any adjustment to the book values of assets and liabilities. Then we'll talk about treatment of reserves. See, if it is an amalgamation in the nature of merger, all the reserves which are appearing in the balance sheet of the vendor company, right, have to be incorporated in the balance sheet of the purchasing company, right? So also it means that the identity of the reserves will be maintained. What all reserves which are there in the balance sheet of the transferor will come to the balance sheet of the transferee. Then if it is an amalgamation in the nature of purchase, then in that case, identity of reserves is not to be maintained, right? The reserves and surplus of the transferor will not come into the balance sheet of the transferee company. But there is an exception. If there are certain statutory reserves which are there, right? If there are certain reserves which are required by statute to be maintained by the vendor company or the transferor company, then in that case only those reserves have to be incorporated in the balance sheet of the purchasing company. And to incorporate these, the entry will be amalgamation adjustment account debit. We'll debit an account known as amalgamation adjustment account and we'll credit the relevant reserves. So now what are these statutory reserves? The example could be investment allowance reserve, development reserve, rebate reserve, etc., which are required by law to be maintained for certain number of years. And once that period is over, this entry will be reversed, the relevant reserve will be debited and amalgamation adjustment account will be credited. Then we'll talk about computation of purchase consideration, and there will be some adjustment which will arise while the amalgamation is done. First, we'll talk about amalgamation in the nature of merger. See, if it is amalgamation in the nature of merger, the shareholders have to be paid in shares. So here what we will see is that what are the value of the share capital issued by the transferee company. From that we will reduce the share capital of the transferor company, and this share capital, when I say, would include both equity as well as preference. The difference, right, which could be a positive number, which could be a negative number, has to be adjusted either with the general reserve or with the profit and loss account. If it is an amalgamation in the nature of purchase, right, in that case we need to follow two-step approach. First, right, because in case of purchase, it's not necessary that all the assets and all the liabilities will be taken up, and it is also not necessary that the takeover might be at book value, because some assets may be at book value, some might be at revalued amount as well, right? So first we need to compute NATO, which is net assets taken over. Net assets taken over will be assets taken over less liabilities taken over. That will be known as net assets taken over, and these assets and liabilities will be at agreed value, the value at which is agreed between the transferee and the transferor. Then we need to compute the purchase consideration. What value is the transferee company paying to the transferor company for acquiring those assets and liabilities? Then we'll compute the difference between two, that is the difference between NATO and PC. If the value of NATO is more and the PC is less, means we are getting more assets but we are paying lesser price, it's a gain, it will be transferred to capital reserve. If our NATO is less and we are paying a greater price than NATO, means that the purchase consideration is higher, that means we are paying for goodwill, and this goodwill which arises on amalgamation as an adjustment, right, has to be written off maximum over a period of 5 years. By this we are done with the revision of AS 14.